So we are in the paper of November 2017. That is the paper that we are supposed to look at. So straight on, the question says that Tripper Limited is a company that specializes in the production of umbrellas. For the year ending that 1st of December 2018, the company is planning to produce special promotional umbrellas branded Jumbo. Tripper Limited wishes to determine the optimal number of umbrellas that should be produced. If all the umbrellas are sold within the year 2018, they will be sold at shillings 900 each. If the company is unable to sell all the umbrellas within the year 2018, they will be sold in the following year at shillings 300 per umbrella. The production cost per umbrella amounts to shillings 400. The demand for the umbrellas depends on the performance of the economy, which is highly predictable. The following are the possible states of economy. We are given that Tripper Limited has to decide to produce the umbrellas at one of the states of the economy in order to match the forecast demand. The opportunity cost of not selling an umbrella that is demanded is shillings 100. Now construct a payoff table showing all the possible outcomes, and then advise the management on the optimal level of production based on the expected value, maximat, and maximum criteria. So that is what we are told to do. So that question 1. Question 1A. Question 1A, it is on single stage. Single stage decision. Single stage decision. So let's have the analysis table. The analysis table still here. And in designing this, we have number 1, to come up with the option. And when we talk about the option, we are talking about the production. We are talking about production. Then we talk about the outcome. Now the outcomes will be the demand. Will be the demand. So from there, we need to get the formula to compute the payoff. And as you can see, we will have units sold in (2018). Now each one of them, according to information 1, will be sold for 900 shillings. 900 shillings. Plus units sold in the following year, 2019. And according to this information, number 2, each will be sold for 300 shillings. Each will be sold for 300 shillings. Then we minus units produced. Units produced. Multiply by the production cost according to information 3 is 400. Is 400. Then you minus according to information 6, we are told any unit that is out of stock will cost 100. So shortage units, you multiply by 100. And this now will give us the payoff. That will give us the payoff. So that is the formula that we are going to use. So design that formula. Once you finish drawing, you let me know. We have finished that. Once you finish, you let me know. Yeah, I can see we are finished. Boniface has just come in, so him we may not wait. Okay. So let's begin. And I want us to use the figures in thousands. Put the figures in thousands. And you see, according to the demand will guide the production. So the first one, we can decide to produce 500. We can decide to produce 500. If you decide to produce 500, there is a possibility demand turns to be 500, or it turns to be 350, or it turns to be 300. You can also decide, I'm going to produce 350. So demand turns to be 500, or 350, or 300. Equally, you can decide, I'm going to produce 300, but demand turns to be 500, 350, and 300. And 300. So we can go one by one. We can go one by one. If you have produced 500 and demand is 500, then all the 500 are sold in that year, each at 900, and there is nothing that remains to be sold the following year, each at 300, and then you have produced 500, each at 400, and no one goes home without each at 100. So that is how it will be argued. So work out that and give me the answer. How much? Because today we are also physical, nyinyi watu wa online, mkichelewa mtatupata mbele kidogo. But I know you will not be very much late. Good, Ivarin? Yeah, 250,000. June? 250,000. I also have 250,000. So put 250,000 there. Yes, good. Then Royce, I can see that. All right, let us go to the next one. If you have produced 500 and demand in that year is 350, then that year you sell 350, each at 900. Then the balance that remains unsold, 150, zinauzwa the following year. Zinauzwa the following year, 150, each at 300, minus production is still 500. We have produced 500, each at 400, and then no one has missed, and the missing is 100. It are used. So work out that and give me the figure. Send the figure. $160,000 is Ivarin. I can see also 160,000. That is also what we have. Yeah, Royce, good, 160. All right, let's go to the next one. You produce 500, but demand is 300. So in that year, you sell 300, each at 900. Then the balance of 200, you sell the following year at 300. Then you have produced 500, each at 400. No one has gone home without. No one has gone home without. So when you put these figures in the cal, you say 300 times 900 plus 200 times 300 minus 500 times 400. You get yourself how much? 130,000 130,000. Yeah, I can see Varin also. 130,000. Let's go to the next. You have produced now 350, but demand turns to be 500. So what you do, you sell these 350 that you umetengeneza this year at 900, plus there is nothing that remains to be sold the following year at 300, and the production is now 350 at 400, but there is 150 customers who will go home without. 150 customers will go home without at a cost of 100. 150 customers will go home without. So send the 350 times 900 minus 350 times 400 minus 150 times 100 is 160,000. 160,000. Yes, Royce, kids. You now have produced 350, but 350 customers come. So you sell all the 350, each at 900. There is nothing that remains to be sold the following year at 300. Production is 350 at 400. And no one goes home without. No one goes home without. So if you say 350 times 900 minus 350 times 400, tell me the figure. 175. Watu wa online. Nakina Churchill, Boniface, and McKenna, you are quiet. I also need to hear from you. Yeah, Ivarin says 175,000. Okay. You produce 350 and 300 customers come. So you sell 300 in that year at 900. Then the balance of 50 to be sold the following year at 300 minus 350 times 400 minus no one will miss. No one will miss. So you have 300 times 900 plus 50 times 300 minus 350 times 400. What is the amount? Yeah, Churchill, I can see even Ivarin. June, have you confirmed 145? 145,000. You produce 300. You produce 300 and hebu tufanyie hiyo. Hebu tufanyie, then you give me the figures. Nione kama tutakubaliana. Do the three of them. Do the three of them on your own. So those are the provisional results that I have. If you agree with them, write agreed. If you agree with all of them. But if there is any that you disagree, let me know. Yeah, Churchill is agreed. June is also agreed. The others. Yeah, Roy is okay. Ivarine, okay. So Boniface and McKenna, I hope you are also okay. So from there, we now design so the summary or the payoffs table, and I want us to use shillings in millions. Shillings in millions. So here we have the option, and here we have the outcome. So the option is 500, 350, 300, and the probability, So the same case here, 500, 350, 300, and then expected monetary value. So this is 250, this is 160, this is 130, then 160, 170, 145, this is 130, 145, and 150, And the probability of good is 0.30, 0.46, and 0.24. 0.24. Okay. Once you finish, so whoever is recording for Boniface, you can tell him to contact me after this. We are not giving permission to record. We are not recording. Okay, so now what we do, the EMVs, I believe you know how to compute. So without much workings, you take this, you multiply by the probabilities. So the first one will be 250 times 0.3 plus 160 times 0.46 plus 130 times 0.24. Send me the answer. Send me the answer. The first EMV, yes, Churchill, 179.8. 179.8. Yes, even Ibarin, good. The next one, the same 160 times 0.3 plus 175 times 0.46 plus 145 times 0.24. I'm getting 163.3. Then 130 times 0.3 plus 145 times 0.46 plus 150 times 0.24 is 141.7. 141.7. So we are given, or we are told to advise them on the basis of expected value. So we are told to advise on the basis of expected monetary value rule. Monetary value rule. So we do have the option, and then we have the EMV. So the option of 500, the EMV is 179.8. 350, we have 163.3. 300 is 141.7. So the advice is, remember we go for the highest. So the highest is this one, 179. So we will tell them to produce 500,000 units of umbrellas. We tell them to produce 500,000 units of the umbrellas. So now from there, the next rule we are taught to use is max rule. So max rule. So this one we have the option, and then we extract the maximum payoff. We extract the maximum payoff. So for 500, 350, and 300, ukipia kwa 500, the maximum is 250. Ukipiria 350, the maximum is 175. Na 300, we have 150. So the maximum, juzi tulisoma hii maneno, tukasema you go for the maximum of the maximums, and that happens to be 500. So once again, we advise them to produce 500,000 units. And I told you it's only a coincidence that the rules appear to suggest the same option. It is not a must. There are times they differ. And the last one is maximum criteria. Maximum criteria. So for the maximum criteria or rule, again we have the option, and we have the minimum payoff. The minimum payoff. So this is 500. The minimum is 130. Then 350. The minimum is 145. And then 300. The minimum is 150. The minimum is 130. The minimum is 130. So this one says you select the maximum of the minimums. So the maximum of the minimums is this one. And therefore, we shall advise that they produce 350,000 units. We shall advise that they produce 350,000 units. So I think we are okay. And if we are okay, we seek to proceed. We seek to proceed. So part B of the question says, Solid Limited produces and sells 3 products, A, B, C. Solid Limited has contract supply products A and B, which will utilize all the specific materials that are available to make these 2 products during the next period. The revenue that these contracts will generate and the contribution to sales ratios of products A and B are as follows. So we have that. Product C will generate a contribution to sales ratio of 25%. The total fixed cost of Solid Limited are 5.5 million during the next period. The management have budgeted to earn a profit of 1 million. So you are told to get the revenue that needs to be generated from product C for Solid Limited to achieve the budget profit. The budget profit. So this is question 1B is on CVP analysis. Is on CVP analysis. So, contribution to sales ratio is given as contribution you divide by sales or the revenue, you multiply by 100 or vice versa, or you just leave it. So if you are looking for net profits, we know it is the contribution minus fixed costs. It is the contribution minus fixed costs. So this one will be like this. For product A, rather, we are looking for a profit of 1 million. We want a profit of 1 million. The contribution sales ratio of A is 15%. So this will be 15% of 10 million. That will be the contribution of A. Plus the contribution of B will be 10% of 20 million. Plus the contribution of C will be 25% of RC, whereby RC is the revenue of C. Then all these we minus, if you put this into brackets, that will be the contribution. You minus the fixed costs of 5,500,000. So I would like you to navigate on your own and tell me The revenue of C will be how much? How many millions? I can see Churchill has already given me 12 million. Shillings, 12 million. Someone else confirm? Yes, June. So the figure is confirmed as 12 million. Yes, Ivarin, confirmed 12 million. So we go to question 2B. Actros Limited, a subsidiary of Master Park Limited, a packaging company, is preparing a budget for the year ending 30th of June 2018 in respect of fuel consumption. The company desires to estimate an equation in the form of y is equals to a plus bx, whereby y is the total expense at an activity level x, a is the fixed cost, and b is the variable cost. The following information relates to the year ended 30th of June 2017. The annual total and monthly average figures for the year ended 30th of June 2017 were as follows. Now estimate the fixed and variable elements of fuel expense from the above data using the following methods. So that question 2B is on cost forecasting methods. Cost forecasting methods. And the first one that we are told to use is the high-row method. Is the high-row method. So in the high-row method, we take the form of a plus bx being equal to y. Being equal to y. Being equal to y. So you scan through the values of x. You scan through the values of x and identify the highest machine hours. So what is the highest machine hours you can find? 48. Good. So if it is 48, you pick like this. Tasema A plus 48B is equal to, the cost of that is 680, and you tell us this is the highest. That has come from the highest. From the highest. Then you go again and scan the lowest. The lowest is 26. And they happen to be two of them. So 26B is equal to 500. And this is the lowest. There is something I said last time we came across this question, that the selection is only for the units. That's where we go for the highest and the lowest, but not in the costs. So the cost depends on what you have picked there. That means this may be the highest, or it may not be the highest. The same case here, this not need necessarily be the lowest. The other thing that has come out with this question is that you have seen there is a tie of some values. Like this one, 26, they were more than one. But fortunately in this question, they also had the same cost. But there are times you will find that the units are tying, but with different costs. In such a case, you are free to choose whichever. You are free to choose whichever. For example, if there was another one that was 26 and it had a cost of 450, we were free to choose this one to make a 450, and to make a 500, whichever. So it should not be a major concern if you come across those variations. So with that, we proceed, and now we subtract, whereby now we say 48 minus 26, what do you get? 22B. So we have 22B, and this obviously is 180. So based on that, give me the value of B. 8.18. We will not keep on, but we can label because it's not everywhere. They will label for you. And this one I told you is the variable cost per machine hour. Variable cost per machine hour. It is very, very important, especially at this level, to be able to label these figures. That is the variable cost per machine hour. Then proceeding, you say A plus 48 times 8.18 should be equal to 680. Tell me what should be the value of A. $287.36. And if that is okay, this is the total fixed cost. Is the total fixed cost. Is the total fixed cost. Yes, Evelyn, you can see that. So if we are okay with that, oh, we should have written the equation. Sasa down there to the same thus y is equals to 287.36 plus 8.18x. So that is the function that they wanted. Ukiulizwa least squares method or simple regression, least squares method, the ideal way, the best way of presenting it is you start with the formula where you tell us y is equals to a plus bx, where you also remind us that b is n sum of xy minus sum of x sum of y. You divide this by n sum of x squared minus sum of x, and then you tell us a is sum of y minus b sum of x. You divide by n. You divide by n. Divide by n. The second step to take is to prepare the analysis table. And the analysis table here, analysis table, it has 4 columns. It has 4 columns. It has a column of x, column of y, a column of xy, x squared, and xy. So you put in these figures 34 versus 640, 30, 620, 34, 620, 39, 590, 42, 500, 32, 530, 26 is 500, another 26 at 500, that one at 530, 35 at 550, 43 at 580, 48 at 680. So quickly, that 4 squared is 1156. 30 square is 900. 1156. I'm going to move very fast because there are those of us who use the calc, and therefore they could be already ahead of me. And what we are doing here is not very difficult. So we can afford a very high speed. But if you're using the calc, you don't have to fill in the table. We just go straight. Someone could be wondering what I mean by using the calc, and I'm still using it. It is doing regression using the calc. That is what I mean. It's only that most of you are not in class when I was teaching this. Nasitaki kuonyesha anything new when it is very close to the exams. So that 4 times 640 is 21,716. 30 times 620 is 18,600. That 4 times 620 is 21,080. That 9 times 590 is 23,010. 42 times 500 is 21,000. That 2 times 530 is 16,960. 26 times 500 is 13,000. 13,000. That 1 times 530 is 16,430. That 5 times 550 is 19,250. 43 times 580 is 24,940. 48 times 680 is that 2,640 plus 24,940 plus 19,250 plus 16,430 plus 13,000 times 2 plus 16,960 plus 21,000 plus 23,010 plus 21,080 plus 18,600 plus 21,760 and according to 41,670 and quickly 640 plus 620 times 2 plus 590 plus 1030 plus 1530 plus 550 plus 580 plus 680, 68, 40, 48 plus 43 plus 35 plus 31 plus 26 times 2 plus that 2 plus 42 plus 39 plus 34 plus 30 plus 34. So if you are agreeing with my figures, say agreed. Are they okay, Jim? Okay, those who are online, Ivarim, you are saying, oh, you already have given the answers. Okay, I don't know what to do to me, the calc straight. Okay, so if we have done that, the last step now is to do the substitution. So substitution, B is N. N, they are 12, right? So it will be 12 times sum of XY, 241, 670, minus sum of X, which is 420, times sum of Y, which is 68, 40. All this You divide by 12 times sum of x squared, 15 to 12, minus 420 times 420. I can see some of us already have the answer. B, you got what? 2 decimals. 4.43. And then A will be sum of y, which is 6840 minus 4.43 times sum of x. You divide all this by 12. Give me the answer for A. 414.82. And thus, the function y is equal to 414.82 plus 4.43x. So that is how you are supposed to present it in an exam. That is the perfect way. So those who are online, if you are okay, you write okay so that I can proceed. Varin is okay. Churchill, okay. Let me hear from Royce and McKenna. Boniface, Juka, Mefika Nyuban. Royce is okay. Okay, McKenna, you are so quiet. So we proceed. So question 3B, Woodmaster Limited makes quality wooden benches both for indoor and outdoor use. Results have been disappointing in recent years, and a new managing director has been appointed in order to boost the production volumes. After the initial assessment, the director has noted that the budgets had been set at easily achievable levels for employees. He urges that employees would be better motivated by setting budgets that challenge them more in terms of higher expected output, other than changing the overall budgeted output. The director has not yet altered the standard cost card. The budgeted output and sales for the month of October 2017 was 4,000 benches. The standard cost card at this output level is provided below. So we are given all that. Overheads are absorbed on the basis of labor hours, and the company uses an absorption costing system. Stocks are valued at standard cost. There were no stocks at the beginning of the month of October 2017. Actual results for the month of October 2017 were as follows. So we are given all that. The average monthly production in sales for some years prior to October 2017 had been that 400 units and budgets had previously been set at this level. Very few operating variances had historically been generated by the standard cost used. The finance director suggested that an absorption costing system is misleading and that marginal costing system should be considered at some stage in the future to guide decision making. So you are required to do the operating variances and come up with a statement that reconciles the profits. So I told you, anytime you see the word reconciliation statement, you do everything at once. Yote zote uziweke kwa statement. Hata kama they are asking other things before the statement regarding the variances, all of them put them in the statement. So that is what we are going to do. That is what we are going to do. That is question 3B. Question 3B, and is on profits reconciliation statements. So I gave you the format that we should always follow. The only time you violated kidogo is if there is the concept of running curves. That is what we said. But this one now does not have, so we comply with the format. I told you we always begin with budget profits. Budget profits. If it is not given, you just compute in the normal way. But for this question, you can see clearly we are told the standard profit per unit is 280. So utasema 280 times the budget units. The budget unit somewhere more information gun. Yeah, slightly before the standard cost card, we are told the budget was 4,000. So multiply this by 4,000. Multiply by 4,000. How much? 1120. 1,120,000. Then we bring adjustments for variances. Adjustments for variances. Adjustments for variances. So for the variances, we said we have sales price. Now sales price, we said the formula is budget selling price minus actual selling price. Budget selling price minus actual selling price. You multiply by actual units sold. Actual units sold. So let us substitute that. Ukikimbia hapo juu kwa the standard card, you will find that the standard selling price or the budget selling price was 2,200. And ukiteremuka hapo chini, where you can see the sales, in information 3. If you get the sales of 7,200,000, you divide by 3,200, that will give you a selling price of how much? 7.2 million divided by 3,200, how much is that? 2250. Those who are online, are you getting the same figure? Yeah, good. Varin, 2250, that is the actual selling price. Now this one, you multiply by the actual unit sold of 3,200. So when you multiply, what do you get? And you tell me whether the variance is favorable or adverse. 160,000 favorable or adverse. This one is favorable. Is favorable. Ibarina, I can see you are saying it is adverse. It is favorable because the actual selling price was high. So it is good news when you manage to sell at a higher price. When you manage to sell at a higher price, it is good news. Huyo mwingine tukasema anaitwa sales volume. And sales volume, we say it is given as budget sales units minus actual sales units, budget sales units minus actual sales units, you multiply by standard contribution margin. Standard contribution margin. So according to the budget, we were planning to sell 4,000 units, but we ended up selling 3,200. Now the contribution margin is given as selling price minus variable costs. So chukua 2,200 minus 800 minus 320 minus 160 and tell me whether it will be equal to 280 plus 640. Are they the same? Yeah. To get the contribution margin, you can either say selling price minus variable cost or net profit plus the fixed costs. So now multiply and give me the answer. Online. You have one. Those who are online, you're very quiet. Yes, Ivarin. Yes, Royce. 736 adverse. Ivarin, you have not said what it is. Churchill. 736. 736,000 adverse. It is adverse because we sold fewer units. Naona tulitarajia kuuza 4,000. Then we ended up selling that 200. So you don't rejoice when you sell fewer units. It is bad news. Haya, huyo mwingine tukasema anaitwa direct materials. Direct materials. So direct materials is given as standard material cost minus actual material cost. Standard material costs minus actual material costs. So for you to get the standard, you go back the standard cost card and you find that our material is called wood, and according to that card, each unit was supposed to cost us 800 units, or 800 shillings. 800 shillings. And because these are production costs, you are supposed to multiply by the unit produced. You can see in the information number 3, total production is 3,000. Total production bench is ni ngapi? Ukiangalia hiyo information number 3, there is somewhere there at the middle. Total production is how many units? That is 600. Good. So those are the ones that you use because it's a production cost. 3,600. You minus the actual material costs. So ukibia for the actual results in information 3 and establish that wood costed us 2,800,000. 2,800,000. So you now subtract that. Tell me how much that is. $80,000 favorable or adverse. It is positive. Eh? Yeah, it is positive. Churchill, that 600 are the units produced. Yes, Royce, I can see that. Good. Churchill, that 600 is the total units produced, the actual units produced. Are you able to see that? It is not that 2. That 2 is what was sold. Ukiangalia your question, that 2 is what was sold. What was produced was that 6, and we therefore had a closing stock of 400. Check whether you are able to see those 3 things. Churchill, are you seeing information 3? If your paper has information 3, you can see wood, labor, variable overheads, fixed overheads, total production costs. Zimeanzia hapo. Are you now able to see? Okay, good. So we are now on the same boat. Let's proceed to the next. That is direct labor. Direct labor is given as standard labor costs minus actual labor costs. Standard labor costs minus actual labor costs. So we argue the same way. This is a production costs. Ukikibia hapo juu kwa standard card, unapata we have 320. And the units produced are 3,600. Minus ukikibia kwa the actual results, you find Labor was 1,120,000. Labor was 1,120,000. So tell me what that figure should be. And tell me whether it is favorable or adverse. No, just that 2,000. That 2,000, which is favorable. Those who are online, are you in agreement? Yes, Churchill. Yes, Ivarin. Good. The next one, inaitwa variable overheads. Variable overheads. Variable overheads. This one again, we know it is the standard variable overheads minus actual variable overheads. Standard variable overheads minus actual variable overheads. So sasa ukikibia hapo juu, the variable overheads per unit is 160. Multiply by 3,600 units produced. Minus ukiteremka hapo chini, we have 600,000. 600,000. So that gives us what? 24,000 advance. Those who are online, are you in agreement? Yes, Royce, in agreement. Yes, can see Varin, Churchill. The next one, tukiendelea ni fixed overheads. Now, fixed overheads, I told you there are two. We start with the expenditure. So expenditure is given as budget fixed overheads minus actual fixed overheads. Budget fixed overheads, you minus the actual fixed overheads. So the question has not consolidated for us the budget fixed overheads, but you should be able to consolidate for yourself. Going to the standard and you pick that 1 unit was supposed to cost us 640. If you can see that. And this was based on the budget. So you multiply by the budget units. Remember, I keep on telling you that the fixed costs are based on the budget. So it is 640 times 4,000 units, which are the budget units. Now you minus the actual, which is 1,960,000. 1,960,000. $600,000. So 600,000 favorable or adverse? Favorable. Mathematically positive. So So it's favorable. Now the next one is called volume. And I told you volume, you only bring it if there are stocks. If you have either closing stock or opening stock or both, that is the only time you bring this one. So in this case, we have stocks. So hii tulisema, it is given as budget output units minus actual output units. Budget output units minus actual output units. You multiply by budget fixed overhead per unit. Budget fixed overheads per unit. Sasa, we budgeted produce 4,000, but we actually produced 3,600. And the budget fixed overhead per unit, we have just said, is 640. Is 6. $256,000 favorable or adverse. Now, in terms of computing operating variances, if you are dealing with operations efficiency, this one is supposed to be adverse. It's supposed. I'm not saying it is, but it's supposed to be when you are in operations, because you have produced less, but the fixed cost remains. Yeah, the fixed cost remains. But for the purposes of profits reconciliation, you interpret it in the reverse. So now that this one was supposed to be adverse, you make it favorable. Why that is so is because reconciliation is about money. And in the same concept that made us to change this formula. Remember, hii formula is not the one we use when we are doing the operations variances. Huwa tunasema ni standard contribution margin minus actual contribution margin. But when you are dealing with the reconciliation, shift to this one. The same case applying there. Good. So with that now, we should be able to bring our actual profits so that we come to the end of the statement. So the actual profit is given. The actual profit, we are told it is 1488. 1,488,000. And then, in order to reconcile, we say what you do. Unasema budget profits plus favorables minus the advance should be equal to actual profits. Budget profits plus the favorables minus the advance should be equal to Has it agreed? Okay. Yeah, Royce, I can see. That's okay. Let's proceed to question 4A. Question 4A. People Limited is planning to launch a new product into the market. In order to determine the introduction selling price of the product, a market research was undertaken. The following information has been obtained from the research under two possible selling prices of 300 and 350. The variable production cost would be 120 per unit for production volumes up to and including 100,000 units each year. However, if production exceeds 100,000 units each year, the variable production cost per unit would fall to 110 for the units produced. Advertising costs would be 9 million per annum at a selling price of 309.7 per annum at a selling price of 350. Fixed costs would be that. Advise the management of People Limited on the optimal selling price. We are told to advise them on the optimal selling price. So that is decision making. Question 4A is on what we call multi-stage divisions. And in dealing with multi-stage, you know very well, we come up with a sketch first. And this one is very direct. There are two prices, and each one has three possibilities. It's very simple. That. Although you could still look at it as you could also treat it as SIGO. You could also treat it as SIGO, because it has only one set of outcomes. But now that we have just dealt with SIGO, where I go in there, I think the first question, so we can draw. So sasa hapa, for us to get the contribution, tutahitaji kuna variable costs of 110 and 120. Si mbaya sana. So I will come here. Nitasema total contribution should be equal to units sold multiplied by variable costs space yangu imekataa kuja vidogo. Space yangu imekataa. Trying to have something like this. Selling price minus variable costs multiplied by units sold. It will give me what I'm calling total contribution. So this is where I will draw my decision tree. One, two, three. Although actually just it's not even 9. Eh? Oh. the price is 300 shillings at 350. If we just take the unit in thousands, this is 120. This is 110 and 140 with probabilities of 0.4, 0.5, and 0.1. This is 1 weight. This is 100. 94. With the probabilities of 0.3, 0.3, and 0.4. In the interest of time, to solve the haraka, this is 300, 300, 300. This is 350, this is 350, and this is 350. Variable cost, we are told it is 120 up to and including 100. But if you go beyond 100, it is 110. If you go beyond 100. So this one then should be 110. This is also 110. This is also 110. This is 110, but this is 120 and 120. And